You are listening to the CMQ Investing Podcast. My name is Chris Franco, and in this episode, I'm going to share with you something that was pretty alarming to me about another way that you might be giving up a lot of your future wealth if you're not paying attention to some of the expenses in various funds you might have in your portfolio. I talk often about expense ratios and the importance of having low expense ratios and just low costs in general. But this specific ratio is called the turnover ratio. And I want to explain to you how I came across it, what you can learn from what I've learned from it, and hopefully you apply, and then share with you what I'm going to do now that I have this information. So without further ado, let's get to it. Okay, so a few episodes ago, I shared the latest update on my personal portfolio allocation. 63% of my total portfolio is allocated into low-cost index funds, and specifically the VTI and the VOO. In case you missed that episode and you don't want to miss any future episodes, you can follow CMQ Investing on Spotify and Apple for free. And if you already are following the podcast, please know that I really do appreciate it. So after I shared my portfolio, I received a few follow-up questions asking, if you had to choose between the VOO or the VTI and just do one or the other, what would you do? There's not a perfect answer here, and I'm not attempting to answer that now, but I want to share with you what I compared between the two to try to get a sense, or at least be objective about what would be the winner. So first, of course, I started with the expense ratio, and both the VOO and the VTI have a 0.03% expense ratio. The dividend, it's a little better for the VOO. It's 1.49% versus 1.42% for the VTI. The past 10-year returns, and remember, the past doesn't guarantee any future performance, but they're very similar. The VOO had 11.32%, whereas the VTI had 10-year returns of 10.95%. But then I came to this other metric, the metric we're going to talk about, and that is the turnover ratio or turnover rate. The VOO has a turnover rate of 2.3% compared to a 4% turnover rate for the VTI. What is this? What does it mean? Why does it matter? Let's talk about it. According to Investopedia, and yes, I am quoting Investopedia, the turnover ratio or turnover rate is the percentage of a mutual fund or other portfolio's holdings that have been replaced in a given year. For example, a mutual fund that invests in 100 stocks and replaces 50 stocks during 1 year has a turnover ratio of 50%. Some funds hold their equity positions for less than 12 months, meaning their turnover ratios can exceed 100%. If a portfolio's turnover ratio exceeds 100%, it doesn't necessarily mean that every single holding has been replaced, however. The ratio seeks to reflect the proportion of stocks that have changed in 1 year. It goes on to note that funds with high turnover ratios might incur greater costs, that is, trading fees and commissions, and generate short-term capital gains, which are taxable at an investor's ordinary income rate. A passively managed fund should have a lower turnover ratio than one that's actively managed, and I can give you an example here. So, Cathie Wood, aka We Believe, Cathie Wood's ARKK fund has a turnover ratio of 71%. Again, compared to 2.3% for the VOO. Here's what the literature for ARKK says about portfolio turnover, by the way, and I think this is interesting and will lead us into the next portion of this conversation. It says that the fund pays transaction costs such as commissions when it purchases and sells securities or turns over its portfolio. A higher portfolio turnover rate may result in higher transaction costs and higher taxes when shares are held in a taxable account. These costs, which are not reflected in annual fund operating expenses or in the example, may affect the fund's performance. And then it notes that during the most recent fiscal year, the fund's portfolio turnover rate was 71% of the average value of its portfolio. So these fees are not shown to you in a way that I think is really usable. But here's where you need to go to get down to the full meat and potatoes here. Within the fund literature, or in some cases on the actual main pages for these funds, you can see the returns after taxes on distribution. So for the S&P 500 ETF for the VOO, it notes that for the last 10 years, the returns before taxes are 12.92%. But when I consider returns after taxes on distributions, it's 12.42%. So that's a 0.5% difference over a 10-year time horizon, which doesn't seem like a lot, but that adds up big time thanks to the power of compound interest. The takeaway here for me is to be thinking about the returns on a after taxes basis, what you will get after taxes are considered. These turnover rates I think only make the better case for why you want to do passively managed things. And again, not financial advice, is just my perspective. But I think even among the passively managed funds that are out there, you need to consider what the turnover rate or turnover ratio will look like, because that does impact the returns for any long-term investor. I mean, it impacts your short-term returns, but the big impact happens over the course of a long time horizon. So let me read you this last thing here. It's from the SEC, the official SEC.gov website. And it notes the following. It says, "This was part of a series called Welcome to Your Money, where," and I quote, "we help you achieve your saving and retirement goals." It says that we have 3 good questions here, 2 of which may help you invest your hard-earned money more efficiently. So the first comes from Kylie K from St. Louis, who writes, "Why do many individuals use passively managed mutual funds, known as index funds, to save for retirement and other financial goals?" Now, you might be saying, "Well, why are you telling me this now? Just hang with me here. It's all related." And the answer here notes that the fees for index funds are generally much lower than the fees for actively managed mutual funds. And over long periods of time, the impact of seemingly small differences in fees can really add up. Of course, everyone cares about the bottom line. When comparing similar mutual funds, lower fees can translate into better performance, according to researchers. And in fact, most actively managed funds do not, quote unquote, beat the market in any given year. It says that studies show that very few actively managed funds, including those with impressive short-term performance records, provide stronger than benchmark returns over long periods of time. Choosing a fund, of course, is a very personal decision. And remember that fees only are one important factor, which leads to this next point, which is all about the turnover ratio. A fund's portfolio turnover rate, which measures how often it buys and sells securities, is an important consideration, particularly if an investor is holding an investment in a taxable account. A fund that frequently buys and sells securities may generate both higher trading costs, which will eat into returns, and capital gains taxes, potentially leaving a higher tax bill. If the investor is invested in a taxable account, he or she should take a look at the difference between the before and after tax returns of the fund he's considering. That information is available in the fund's prospectus. The difference in pre-tax and after-tax returns for funds with a higher turnover rate, that is, can be quite striking. And that's what I want to just, more importantly, above anything else, is that's why I want you to be aware of this, because the differences in this small little ticky-tack way that we as investors have to pay more than we realize, well, it can do a lot of damage to the long-term wealth that you should be able to accumulate. It can take away from that. And that's, the antithesis of what we're trying to achieve together as, a community, but as part of this content known as CMQ Investing. Now, I want to leave you with a little wisdom, a little bit of detective work, I guess you could even say, from none other than Jack Bogle. According to an O'Reilly.com piece here, and this O'Reilly.com is a publishing company, it says that mutual fund managers who enthusiastically swap investments cost you money both in brokerage commissions and taxes on capital gains. John Bogle, the mutual fund investing guru, views such managers as no more than short-term speculators who raise your fund costs an estimated 2 to 3% of your fund assets annually through higher brokerage commissions and market impact costs. A recent Standard & Poor's study validated Bogle's suspicions, proving that low turnover funds outperformed their higher turnover cousins. Keep that in mind. Proving that low turnover funds outperform their higher turnover cousins. If you're investing in a taxable account, taxes take another bite out of your profits when mutual funds distribute capital gains, interest, and dividends. A look at a fund's turnover rate can tell you whether a fund manager trades frequently or buys and holds for the long term. Fund companies calculate annual turnover rates by dividing a fund's total investment buys and sells by average monthly assets. In addition, tax-adjusted returns represent the return you earn with a fund if you have to pay taxes on distributions, such as when you hold funds in a taxable account. Before you buy a mutual fund, particularly in a taxable account, and this could be applied to an index fund as well, use turnover rates and tax-adjusted returns to determine whether it's appropriate. And I want you to remember that last point there. Use turnover rates and tax-adjusted returns to determine whether it's appropriate. And that's something that moving forward I will always do. Luckily, my fund of choice has an extremely low turnover rate, but that doesn't mean I'm not going to keep a very close eye on this. And I'm also going to be thinking about everything from a tax-adjusted basis just to prevent something else like this creeping in without me realizing it. So I hope that's very helpful for you. I hope you can use that information. For CMQ Investing, my name is Chris Franco. If you'd like to follow up with me, send me a DM on Twitter @ChrisFranco. And you can always respond or give us feedback at cmqfeedback.com. Thanks so much.